All right, so we've got here Meals on Wheels, MOW, operates a meal delivery home delivery service. It has agreements with 20 restaurants to pick up and deliver meals to customers who phone or fax orders to MOW. They really have to update that. MOW allocates variable and fixed overhead costs on the basis of delivery time. So we now know that their cost driver is delivery time. MOW's owner, Josh Carter, obtains the following information for May overhead costs, and they give us a bunch of information. Required. Calculate rate and efficiency variances for MOW's variable overhead in May. So we do have this information right here, and I've just copied this over here. So I'm just repeating it. We have actual and we have the static budget. We know that we've got output. Actual is 8,800. We were supposed to do 10,000. That's how many meals the company was supposed to do. The hours per delivery, and this is standard. So the standard hours per delivery is 0.7 hours. So that's what we believe it will take us. Now, did it actually take us that? We can take the hours of delivery time, which was 5,720, and we could divide it by the 8,800, and we discover that the hours of delivery, just 1 second, going to change this, was 0.65. So it took us less time, which is awesome. Now, hours of delivery that were static, well, multiply the 10,000 by the 0.7, it should have taken us 7,000 hours. It didn't. It only took us 5,720. Awesome. Now, actual variable overhead cost per hour of delivery time. Well, we know what our overhead variable costs were, 10,296. If I divide that by the hours of delivery time, it will tell me what my actual application rate was. It's $1.80. But let's just look at what the variable overhead application rate, how it's calculated. It is calculated as total budgeted variable overhead, and we divide it by the total budgeted cost driver, which in this case happens to be delivery time, right? And that's delivery time per unit multiplied by the budgeted units, in this case, like meals of delivery. So we can see right away that we can calculate what was the budgeted overhead costs, because if I take the variable overhead cost per hour of delivery time, so don't forget, this is the application rate, and I multiply it by the hours of delivery time, 7,000, I can see it's 10,500. So let's just look at this again, right? I am solving for the total budgeted variable overhead. I know the application rate is $1.50 per delivery. Okay. And when I look at that, that has got to equal the total budgeted variable overhead, which I don't have. So it's X dollars, right? It's just X. And I'm going to divide that by the total budgeted cost driver. That is delivery time per unit. There it is. And then multiplied by the total number of units I expect to deliver, 10,000, that's 7,000. So I'm solving for this number right here. Okay, so when I do that, I'm going to multiply both sides by 7,000. Just a second. I'm just going to put a line under here. Right. So when I multiply both sides by 7,000, it's $1.50 multiplied by 7,000. That is equal to 10,500. Okay, so that's how I got the 10,500, by understanding exactly how the variable overhead application rate is calculated. Similarly, the fixed overhead application rate is going to be equal to the total budgeted variable overhead divided by the total budgeted cost driver, which is, of course, the delivery time per unit multiplied by the budgeted units. Okay, so I don't have an application rate for the fixed. Doesn't exist. I'm not showing it, right? But I can calculate it because I know that the fixed overhead application rate is going to be equal to the total budgeted fixed overhead. Oh, I'm said variable. I apologize. It should have been fixed. So let's just change this to fixed. There you go. Okay, so I need the total budgeted fixed overhead, and I need to divide it by the total budgeted cost driver. Remember, that's the delivery time per unit multiplied by the budgeted units, 7,000. So that's going to give me my application rate for the fixed overhead. The application for the fixed overhead is $5 per delivery. And I'm just going to change this into dollars so we know what we're looking at. There we go. So keep in mind all of these interacting amounts. You need to understand how to calculate the variable overhead application rate and the fixed overhead application rate. Otherwise, you won't be able to do calculations. Now, it says calculate the rate and efficiency variances for the variable overhead in May. We can use the diamond approach. So this is exactly the same. We're going to do the variable overhead price variance and the variable overhead efficiency variance. So this is the actual price. But what this really is the application rate. If we're doing variable overhead, we need the actual application rate. So the actual application rate is $1.80. Standard application rate is $1.50. Now, the actual quantity, what we want here is we want to use over here the actual number of hours that meals were delivered, right? There we go. So that is 5,720. If we do this math, I'm going to do the same math over here. And then I'm going to do the difference between these two. So now I can see that, don't forget, we look in the diamond to see if it's good or bad. We were supposed to have an application rate of $1.50 and we had an actual application rate of $1.80. This is bad, unfavorable. So we know the variable overhead price variance was unfavorable, $1,716. If we go over here, we can take the actual and we're going to take the standard. And then we're going to calculate the standard quantity, which is the actual units produced. Well, now it's the actual number of meals delivered, 8,800. And we want to multiply that by the standard cost driver per unit. In this case, per meal. Standard cost driver is 0.7 because that's the hours per delivery. And so now I can calculate this. That is 6,160. So that's the total number of hours that they should have spent delivering meals. We can now do this calculation. And this one. And we can see that the difference is $660. Now, is this good or bad? We look in the diamond. We should have spent 6,160 hours. We only spent 5,720. This is favorable. So now we can look at the total right over here. And if we look at the total, we're going to take the difference between these two amounts, just take the larger, subtract the smaller. And is it favorable or unfavorable? We look, this is unfavorable. This is favorable. That's why I subtracted them. The unfavorable is larger, so it's unfavorable. So we have an overall unfavorable variable overhead variance. It was a result of an unfavorable price variance and a favorable efficiency variance. So we actually took less time delivering the meals, but the application rate, the actual variable overhead, was higher than what we thought it should be. All right, so we're now going to go up here and it says, what's our next thing? Calculate the rate variance and the production volume variance for the fixed overhead for May. So we're going to use the column approach because we can't do anything else but the column approach. That's the only thing that works with the fixed overhead. I need to know what was the total fixed overhead. I actually have this piece of information. So I'm going to get the total fixed overhead actual. So total fixed overhead actual. And then it says over here, okay, what was our master or static budget? Well, we already calculated this. It was 35,000. Remember how we calculated that? So now we can take the difference between these two. And we can say whether this is favorable or unfavorable. Well, I was supposed to spend 35 and I spent 38. This is bad. It's unfavorable. All right, now we look at the production volume variance. Remember how we calculate this? We want the actual production. Well, this is the actual number of meals delivered, which is 8,800. Now that's red, and the reason it's red is because this is the only thing that changes between the static budget and the applied. So because it's the only thing that changes, it's what tells us whether it's going to be good or bad for the company. We're going to multiply this by the standard cost driver per unit. We know what the standard is. The standard is 0.7 hours for each delivery. We're going to multiply this, and don't forget this is hours per delivery. Okay. So now I'm going to multiply this by the standard application rate. We know the standard application rate, it's $5 per delivery. So per delivery. Let's change that also. Okay, so I can multiply these out now. It is $30,800. I can take the difference now. Is this good or bad? I should have delivered 10,000 meals per day. I only delivered 8,800. That is bad. That is a poor use of my fixed assets. So this is unfavorable. So the total fixed overhead is going to be the two added together because they're both unfavorable. So that is going to be $7,800 unfavorable. So let's look up here. What does it say now? Comment on the overhead variances and suggest how Joss might manage their variable overhead differently from its fixed overhead costs. Okay, so let's go down here and we're going to comment overall. We can see that we were very efficient. So the fact is, for the number of units we did deliver, we did a good job. We delivered them in less time. And we know that because if we look up here, the hours of delivery, right, we were budgeting 0.7 and we only spent 0.65. So we did a really good job in delivering the meals that we delivered. Now, unfortunately, the variable overhead was more expensive, and the variable overhead could have been more expensive for, a number of reasons, most likely because of things like gasoline, which we don't have control over, right? So we know that we spent more money per hour of delivery time, and we saved on our actual delivery time, which is awesome. Now let's look at the fixed overhead variance. We see here that we spent more money, and there could have been a variety of reasons why we spent more money, but when we look at this, we definitely did spend more money. We would have to look at the fixed overhead, like what goes into the fixed overhead, in order to determine exactly where we spent more money. And keep in mind what fixed overhead is. It's like supervisor salaries and the cost of renting a location, and it might be the cost of property taxes. It's those fixed costs. So it might be we bought new fixed assets, and so our depreciation went up because the depreciation would go in here also. We need to learn how to control those things, or we need to at least look whether we can control those things. Now, over here, what we see is the production volume variance. We didn't utilize the capital assets well enough. We didn't deliver enough meals. And that's the reason why it's unfavorable. Now, it does say, comment on the overhead variances, which we did, suggest how Josh can manage the variable overhead differently from the fixed overhead. The variable overhead, we're looking at a mixture of long run, what are we spending our money on when it comes to variable overhead, as well as the short run. How can we reduce the delivery time? When we're looking here at the fixed overhead is always long-term. Even when we're looking at the price variance, it's always long-term because the fixed overhead doesn't change with the level of activity. If we want to change this, we need to change our property tax rate. We need to change how much we spend on insurance. We need to change how much our depreciation is. We need to, these are all big long-term decisions. And over here for efficiency, we have to change how well we use our fixed assets. So that's the real difference. We're looking at a purely long-term decision-making model here for fixed overhead compared to the variable overhead, which is both long-term as well as short-term. So keep in mind the variable overhead, we deal with it differently because it varies with the level of activity, whereas the fixed overhead does not vary with the level of activity. So we've got to look at the long run for our fixed costs. All right, that's it for 8-23.